Hey, it's Claire from Pit News Magazine, and welcome to Pit News on Air. So, it's October. That magical time when pumpkin spice invades our lattes, ghosts invade our front yards, and traders start whispering about the October effect like it's the boogeyman of Wall Street. But here's the thing. What if October isn't cursed at all? What if it's just misunderstood? Today, Jake and Lena are diving into one of the market's most misunderstood myths: why October feels terrifying, even when the stats say it's not that bad. We'll talk about crashes, psychology, volatility, and maybe even the mysterious Halloween effect, because apparently, markets like to rally once the candy wrappers hit the floor. So grab your favorite brew, keep an eye on those charts, and let's see whether October is really a curse, or just a costume.
Welcome back to the Deep Dive. We've got a really interesting stack of research you sent over historical deep dives, stats, behavioral studies, and they all point to one thing: October in the financial markets.
That's right. We're tackling the infamous October effect. You know, that feeling, that long-standing belief on Wall Street that October is just inherently risky, cursed even.
Yeah, the month for crashes.
Exactly. It's this persistent financial superstition.
So our sources are asking, does this reputation actually match reality? Is October really a curse? Or maybe a catalyst for better months ahead? Or is it just, coincidence blown out of proportion?
That's the mission today, separating the perception, the story we tell ourselves, from the actual patterns in the data.
Okay, so let's unpack this. Because we have to start with why October has this reputation in the first place. It didn't just appear out of thin air, right?
No, absolutely not. The fear is rooted in some, truly monumental historical events. October has been the backdrop for some of those damaging financial moments in modern history.
Right, the big ones, the ones everyone remembers. Yep. We have to start with 1929, the Great Crash.
Black Thursday, Black Tuesday, late October. That wasn't just a market dip. It was the beginning of the Great Depression, the scale of it, the emotional weight. It's hard to overstate.
Huge. Then you jump forward quite a bit to 1987.
Black Monday, October 19th. The Dow dropped, 22.6%?
In a single day. A single trading day.
Yeah. Imagine a fifth of the market's value just vanishing in hours. That leaves a scar.
And then, more recently, 2008, the global financial crisis.
Yeah.
October wasn't the start, but it felt like the peak panic.
Oh, absolutely. The crisis was building, sure, but October 2008 was just relentless. Credit markets seizing up, near daily plunges, pure fear. So yeah, you hear October and those dates, 1929, 1987, 2008, they just flash in your mind.
That's the narrative. Powerful stuff.
It is powerful, but here's where the analysis, the data, forces us to pivot. These events, as massive as they were statistical outliers. They weren't a reliable pattern.
Outliers. Explain that.
They were caused by really deep systemic problems bubbling under the surface for months, even years. Things like asset bubbles, too much leverage, gaps in regulation.
Right.
These problems just happened to reach their breaking point, to erupt, during October. The month itself wasn't the cause. It was just the stage, the backdrop for the final act.
So the calendar month gets blamed for these deeper structural issues that were brewing long before. Okay, so if those were outliers, what does the typical October look like? How does the reality stack up against this terrible reputation?
It's surprisingly different. If you look at the S&P 500, say, over the last 75 years or so, October actually finished positive in almost 60% of those years.
60% positive.
Yeah.
That seems completely counter to the whole cursed month idea.
It absolutely is. And what's more, the average return for October, historically, it's around positive 0.9%.
Okay, 0.9%. So slightly positive on average. Where does that rank it compared to other months?
Bang in the middle. Mid-pack. Not great, not terrible, often, frankly, unremarkable.
But the fear is remarkable. That's the puzzle, isn't it? If the stats show it's average, maybe even slightly positive, why the widespread dread? Why does this feeling persist so strongly?
Now we get into the psychology. It's a classic trap, really. Behavioral economists talk about availability bias.
Availability bias, okay.
Our brains, you see, they aren't really built like spreadsheets weighing probabilities objectively. We're wired to remember things that are dramatic, emotional, vivid, like a market crash.
Right. The 22% drop in 87, you remember that.
Exactly. That's burned into collective memory. But a calm October with a, 0.9% gain like in 2012 or something.
Forgotten instantly.
Poof. gone. So every year when October rolls around, what happens? The media starts talking about the crashes, fund managers might mention it in notes, nervous investors remember the fear.
And it creates this feedback loop.
Precisely. A self-fulfilling loop of caution. The perception of risk spikes sky high, even if the underlying economic fundamentals haven't really changed that much.
Okay, but hang on. If everyone believes October is risky, and they act on that belief, maybe they sell more or hedge aggressively, doesn't that fear actually create real risk? Isn't psychological risk still? Well, risk.
That's a really sharp point, and yes, the sources definitely address this. The initial trigger might be psychological, this availability bias, but the result can be very real volatility.
How so?
Well, if you look at studies using the VIX, the market's fear gauge, they don't actually show that October's average volatility over the long term is consistently higher than other volatile months, like, say, February or sometimes June.
Okay.
But what does happen, particularly in the run-up to October, is that the anticipation of trouble, fueled by this memory bias, causes big players, institutions, to start hedging more aggressively. They adjust their positions.
So everyone rushes to buy insurance puts and things like that.
Right, and that concentrated buying of protection or maybe some preemptive selling can definitely make prices jump around more in the short term. The market gets jumpy.
Because everyone's bracing for a ghost from 1987 or 1929.
You could put it that way. Yeah.
Yeah.
It's like a psychological hangover from past traumas causing real physical market symptoms right now.
Wow.
Exactly. We anticipate the drama, and that anticipation becomes action. But if we step back from the ghost story for a second and connect this to the bigger picture, October's real significance might be less about crashes and more about its place in the broader seasonal cycles of the market.
Okay, shifting gears from psychology to seasonality, like the whole sell in May thing.
Precisely that. Sell in May and go away. It sounds like folklore, but there's a long history behind it. Statistically, markets have tended to perform better during the 6 months from November through April compared to the 6 months from May through October.
So May to October is the historically weaker half of the year.
Generally speaking, yes. And October sits right at the very end of that weaker period.
Ah, okay. So it's not necessarily inherently bad itself. It's just the last month of the weak season, kind of the cleanup month.
That's a good way to think about it. And crucially, that position makes it the pivot point. It sets the stage for what often comes next, which is sometimes called the Halloween effect.
The Halloween effect.
Yeah, it's the observation that market returns tend to pick up, sometimes quite dramatically, right after October ends, as the market looks ahead to those historically stronger winter months, November, December, January.
Interesting. So if the market's been sluggish since May, maybe investors use October to clear out loser positions, get ready, and then things tend to improve. That feels more logical than a curse.
It provides a more structural framework, definitely. Now let's drill down even more. Even within the month of October itself, there are often patterns. It's not usually monolithic. Sources often describe it as a month of two halves.
A weak start, strong finish, maybe.
Often, yes. The first few trading days of October can be quite soft.
Why is that?
It often comes down to institutional mechanics. Think about calendars. A lot of mutual funds and large institutional investors have fiscal quarters ending September 30th.
Right. End of Q3.
So early October becomes a time for what they call post-quarter rebalancing. They might be selling underperformers to lock in losses for tax purposes, adjusting their overall asset mix, maybe dealing with outflows from investors.
So the big players are effectively cleaning house right at the start of October, and all that selling puts downward pressure on prices for a few days.
That's often the case. But, and this is key, that early weakness frequently doesn't last the whole month. Research shows markets often find their footing, sometimes quite strongly, around mid-October.
And what drives that turnaround?
It often lines up pretty well with corporate earnings season really getting underway. Third quarter earnings reports start flowing in earnestly by, say, the second or third week.
Actual company news, fundamentals.
Yeah, exactly. And often, if expectations were maybe lowered going into the month due to all the October fear, those earnings reports can provide the positive catalyst, the fuel needed for a rebound.
Okay, that makes sense. Mechanical selling pressure early on, then fundamental news potentially lifting things later. What about external factors? Politics must play a role, especially in the U.S. October is often crunch time politically.
Oh, absolutely. Politics is a huge amplifier of October stress, especially in U.S. presidential election years.
Right before the November vote.
You've got the final debates, polls swinging wildly, just general election jitters. All that uncertainty makes markets much more sensitive, much more defensive. And historically, October performance is noticeably weaker and more volatile in those presidential election years.
So the psychological baggage of October meets the real-world stress of a tight election. Volatility spikes. Makes sense.
It does, but look at the flip side. In years without a presidential election, midterm years or off years, that specific political overhang is gone. And guess what? Average October performance actually improves. It bumps up closer to, say, 1.2% on average.
Interesting. So that really highlights how external uncertainty, not just the calendar month, drives a lot of the volatility we see.
It's a major factor. Then you also have other institutional things creating short-term noise, or churn, as some call it.
Like what?
The big one is monthly options expiration, usually the third Friday of the month.
Always a busy day.
Can be. You get forced buying or selling as those derivative contracts expire and have to be settled. It can distort prices temporarily around that date. But interestingly, analysts often note a tendency for markets to rally after October options expiration.
Why would that be?
Possibly because that forced selling pressure gets lifted, positions are squared up, and the market can look forward again. Plus, you're getting closer to that positive seasonal window.
And you mentioned institutional year-ends earlier. Doesn't that play a role too? Not everyone's year ends December 31st.
Good point. For some funds, September or October is their fiscal year end. So you might see a final flurry of repositioning, maybe some window dressing as they finalize their books before heading into November and December. It just adds another layer of activity.
Okay, so bringing this all together, for you, the listener, thinking about navigating October markets, what's the takeaway? If it's not actually cursed, how do the pros handle it? Do they just ignore the reputation?
Not ignore it, no. They approach it with heightened awareness and preparation. They know the psychology, they know the seasonal tendencies, they know the potential institutional flows. It's about being prepared, not scared.
So what does that preparation look like in practice?
Well, you often see increased hedging activity leading into or early in the month. Portfolio managers might buy more protection, things like VIX options, or put options on indexes or specific stocks, basically, insurance against potential volatility.
Betting against the fear, or at least protecting themselves if the fear turns into real selling.
Exactly. They might also rotate portfolios a bit, maybe shifting towards more defensive sectors temporarily, like utilities, healthcare, consumer staples, things that tend to hold up better if the market does get choppy.
Being strategically cautious.
Right. And adjusting risk exposure around known event clusters like key earnings reports or in election years political milestones. They anticipate potential weakness in the first half and try to position themselves to maybe benefit from a potential rebound in the second half. It's definitely not a month to just bury your head in the sand.
So this leads us to what feels like the core conclusion from all this research. October isn't cursed, it's more like a mirror.
That's a perfect way to put it, yes. October reflects everything back at us. The market's deep-seated fears based on past traumas, the collective hopes for a strong year-end finish, the underlying psychology of investors, the mechanical realities of institutional flows. It's all there.
A balance between caution, driven by memory, and opportunity, driven by seasonality and fundamentals.
It's a powerful reminder that market reputation, the story we tell, can be very different from the statistical reality.
Okay, so let's recap for everyone listening. October's scary reputation, built mostly on a few incredibly dramatic, unforgettable historical crashes.
Right, vivid stories.
But the actual data shows a pretty average mid-pack month, maybe slightly positive returns overall. Its real significance is likely as a turning point.
At the end of the weaker season, the pivot towards the historically stronger November-April period, influenced by predictable institutional flows, earnings season, and yes, our own psychological biases.
So here's a final thought for you to mull over, based on everything we've discussed. If October statistically tends to see markets stabilize or even rally mid-month, maybe after options expiration. And if it acts as this launching pad into the stronger Halloween effect season.
Right, the setup for the winter rally.
Then maybe the real risk in October isn't the phantom crash everyone fears based on old stories. Maybe the real risk is being too cautious, ignoring the potential opportunity that often emerges right when collective fear is at its peak.
That's a fascinating point to end on. Perhaps the smartest approach isn't avoiding October, but understanding its dynamics, the fear, the flows, the turning point potential. Realizing that sometimes the biggest opportunities show up precisely when everyone else is focused on looking in the rearview mirror at past catastrophes.
And that's it for this week's Pit News on Air. Turns out, October isn't the monster under the bed. It's just the month that tests whether you can keep your cool while everyone else screams crash. Big thanks to Jake and Lena for walking us through the madness, and to our friends at TradeMiner, the real pros at uncovering seasonal patterns that actually matter. If you loved this conversation, subscribe to Pit News Magazine at pitnews.com for even more trading insights. And don't forget to follow our Pit News on Air podcast, where you'll get fresh market stories, data magic, and plenty of Claire chaos every Wednesday. Until next time, remember, the only thing scarier than October volatility is missing the rally that follows. See you soon.